Hey, good people. Before we start this podcast, I wanted to let you know a little something. If you haven't heard about Anchor, it's the easiest way to make a podcast. Let me explain. First of all, it's free. And not only that, there are all these creation tools that allow you to record and edit your podcast right from your phone or your computer, just like I did. Anchor will also distribute your podcast for you so it can be heard on Spotify, Apple Podcasts, and many other platforms. You can even make money from your podcast with minimum listenership. It is everything you need to make a podcast in one place. So what do you need to do now? Download the free Anchor app or go to anchor.fm to get started. Hey, podcast family. Welcome back to another edition of Real Talk in Real Estate. It's your girl, your host, Kim McBride, also known as Get Keys with Kim. I'm excited again to be joined by a new guest, Miss Sakinah Tillman. She's here to talk with us a little bit about investment properties and taxes and all things related to how we keep the IRS off our back. And I'm sure some other really good financial and tax tips. So Ms. Sakinah Tillman is the managing member of Tillman LLC, where she represents clients in collection and appeals matters before the Internal Revenue Service and state taxing authorities. She advises clients with business formation and tax planning, and she also prepares federal and state tax returns for individuals and businesses. Ms. Tillman received an LL.M in taxation from the University of Baltimore School of Law. In May 2015, she received a Juris Doctor from Thomas M. Cooley Law School in 2013 and a Bachelor of Arts in Political Science from Bloomsburg University in 2009. She is admitted to practice in Maryland and the United States Tax Court. Miss Sakinah Tillman. Sakinah, thank you for joining us.
I really appreciate it.
No, I love pulling on my experts that are in the community. You've been doing work, especially on the legal side, for some years. And I know that when we discuss real estate, there are legal ramifications that one should consider and be mindful of while they're in the business, getting into the business, and even closing businesses. So I'm just glad that I was able to call on you to be able to assist us and educate us today.
To be here, so thank you.
So, no problem. Okay. So I feel like we have a good foundation of who you are, but tell me a little bit more about yourself. Why did you get into tax law? Why did you end up going into law school? Why open your own practice? Tell us a little bit about how Tillman got started.
So that's a lot of questions. Well, first, I always wanted to be an attorney since I was 8. And that was my childhood dream. So I never deviated from it. I never thought about, pursuing any other dream. That was my plan A. And I was a firm believer that if you have a plan B, you had this idea that plan A would fail. And so I just stuck to that. And my goal was to be a government contractor attorney. In other words, I wanted to be the person, I thought I wanted to be the person to sit behind a desk, review contracts, and just write contracts because I love to write. And it wasn't until my second year in law school that I took a federal income tax course. And I love math. I was a math tutor in college. And I was like, I really like this class. And after that class, I did an externship in Prince George's County with a tax law firm. And I realized this is where I want to be. And so after graduating from law school, and before passing the bar, then after the bar, I always worked in a capacity of handling tax matters. And I liked it. And I think one law firm that I worked at in Bethesda, I was laid off. And it was my idea to say, never just stick to just having one source of income and try to, how to make money. So let's do that. And I created my law firm and I never looked back. And I have another business where I do tax preparation. I did that 5 years ago. But my law firm, I was able to do more things in the capacity of an attorney. And that's what I wanted to do. So I've had my law firm for almost 3 years now. And that's how I got there. And Tillman LLC has been
Yeah,
doing
so
pretty
that's
well.
great. When I tell you, you said, "Oh, I've always liked math," and I'm like, look, there is someone in the world that likes math. Yes, that's a great thing. But to be able to merge your love of math and law is amazing. So it's nice to know that you're walking in your purpose, because sometimes you'll meet entrepreneurs or people wanting to start businesses and they're just looking to go into it for the money. Like, it's not necessarily a passion of theirs. So to know that this has been something that has been placed on your heart to do for a long time
I
is
appreciate
amazing.
that. Thank
And
you
I
so
commend you
much.
for that. So, usually when I think of a tax attorney, I think of trouble. If because most people say, "Oh, I can just get on TurboTax, or I can just do the taxes myself, or I can hire a tax professional to do taxes for me." So, can you speak to maybe some misconceptions or even some advantages of hiring a tax attorney? What exactly a tax
Right.
attorney does?
Um, so a tax attorney, it's a broad title because tax attorneys do various things. In my capacity as a tax attorney, I make sure, one, that you don't get in trouble. And if you are in trouble with the IRS or the state, I help you get out of it. Now, the deeper the hole that you put yourself in, that's going to be more work and, of course, more money. But the advantages of a tax attorney is an attorney in itself is someone that's admitted to practice in their prospective state. A tax attorney has jurisdiction where they can represent any client in any state regarding a tax matter. And what tax attorneys do, especially in my capacity, is that if you have a legal problem, we can help you. So, for example, let's say that you have an issue with the IRS and you owe the IRS a lot of money. You can go to an attorney. They know the law, they know the case law, they know how to understand how the law works, and they can negotiate. If you hire a CPA can help you with an audit, but a CPA is going to always refer to an attorney when there's an audit involved. And so a CPA, which is a certified public accountant, they can do the minimum. They can't do as much as an attorney. If you have to go to court for a state tax matter or a federal tax matter, a CPA cannot represent you with that. An attorney can. And so a lot of times people had the misconception that, oh, well, I can get my accountant to do all these things. Your accountant may be able to put the documents together for an audit, and they may be able to help represent you with an IRS audit. But when it comes to understanding the law, most times, probably 80% of the times, an accountant always has legal counsel to help assist them with those matters. When it comes to tax preparation, CPAs are really good because they know the different ways of, expensing and what's considered income, and they're trained to do tax returns. And there's some CPAs that do financial planning. Some tax attorneys do not handle returns, but a tax attorney would be more beneficial, especially if you have a business, because we can give you legal advice as to what's the best entity for your business. A CPA cannot give you legal advice. Now, there's some attorneys that are also CPAs. In that capacity, they can give you legal advice. But if they just had the CPA designation, they cannot tell you, nor can they prepare the legal documents for you to get that business entity. They could tell you the tax treatment for each business structure, but they cannot advise you and give you legal counsel on which one is best for you and complete the documents. They have to refer to legal counsel.
Gotcha. Okay. So if I'm hearing you correctly, even with the hiring of a tax attorney, it can be a
Absolutely.
proactive and not a reactive type of situation. So, okay. So, and like I said, I think sometimes when you think of attorney, you always think of there's trouble brewing and you need to then hire someone to represent you. But it's just good practice that maybe even in this case, when we're talking about individuals that are looking to invest in real estate, would you suggest that they seek, guidance from
Absolutely.
a
They
tax
can
attorney?
they can seek. I would recommend two people. I would recommend hiring a tax attorney because they could tell you the tax treatment, and then also working with a real estate attorney. A real estate attorney can tell you more about the legal documents such as deeds and what are the legal ramifications about that. But the tax attorney can help you save money, and they can make sure that you have the best structure for your business. So those are the two people that I would recommend in those circumstances. Yes.
Gotcha. And you mentioned a term, so just so that the listeners are clear, when you say
So
tax
tax treatment
treatment,
just
what
means
does that
that
mean?
when you say tax treatment, that just means, well, are you going to have what's advantageous to you? Like, are you going to have a tax liability, meaning that you may owe taxes, or how can you save from a tax perspective, like having an LLC versus a corporation? And so that's dealing with tax treatment. Based entity, is it going to help you or is it going to hurt you? And if one is better than the other, how do you properly plan to get the best results for you? And every person is different based on their business. If this is a second, like a side hustle compared to like their full-time job, or they're just a full-time entrepreneur. So that's what tax treatment means as a whole.
Okay. So you've also talked about business entities. So if an individual or individuals are looking to get into real estate investments, should they do it in the name of a business? And then if so, how do they go
So
about
it's
taking
that's
those
a
steps?
I would say it's a complex question because it really depends on the person and their type of business and other things they may have to report on their tax return. Um, like some businesses, let's say they're
Okay.
a high end investor and they have a lot of like capital investments, and they have loans they're able to get to the bank. In some circumstances, a corporation may be more suitable because they're able to get loans that way. Like some loans will require you, or some capital investment may require you to have a corporation compared to an LLC. So it really depends. And usually when it comes to trying to figure out the best entity, it requires a consultation to pretty much go through everything. And then we're able to make the
Okay.
best decision. So it really depends on the client, honestly.
Gotcha. But do you recommend it over a business
I
name
will.
or entity versus
Right.
an
So I would
individual name? Are there
recommend,
ever
if you're going to do real estate investment, I would
no?
recommend having the real estate investment in the business name because it shields you from personal liability.
Okay. And so when we're talking about liabilities, let me just make sure, what would you consider would be the major liabilities that a business or an individual would face financially? We'll talk taxes wise, when they're looking into investing. What are those common things that you may
Hmm.
see?
That's a really good question.
And the reason why I ask, and kind of just to follow up with that, so I remember at one point when I first started in investing, there was a lot of conversation about, once I went for financing, was I going to get
Mm-hmm.
financing in my name, Kim McBride, or was I going
Mm-hmm.
to do it in my business name? And then how that looked at the end of the year. So I ended up going the hard money route
Mm-hmm.
instead of a traditional bank lender. And even when it came time to do taxes, they didn't provide any type of forms or sheet. Like a lot of it was on me to have kept those documents and things like that. So is that something that, even in situations where that is concerned, is that something that you would recommend as far as when investors are looking to mitigate some liability or take some liability
So
off their
let me
plate?
so let
Like,
me let
how
me
does that?
let me add some things to your question. So when you asked me about liability, as far as what kind of liabilities a business can face versus a individual. So one thing to keep in mind is that a business, like a limited liability or corporation, it should, when I say it shields the person from individual liability, that just means it shields them from lawsuits. And so in other words, let's say that you have a business but you decide to have it in your name and not form an LLC. let's say a deal goes wrong and someone gets sued, they can actually sue you. But when you have a business, they can sue the business. So you're pretty much off the hook unless an exception applies. The exception is if they can show that there was some fraud involved. If there was fraud, then the individual will be responsible. As far as mitigating damages, that's just one of the biggest damages I can really see. Another thing to keep in mind is that when you have a business, and especially if you are investing, it looks more professional to have everything in a business name versus the individual. Secondly, you may be entitled to more like loans and things of that sort. But when it comes to liability, that's the main liability I can really think about. Now, when we start talking about, write-offs and things of that, so that's a little different. But as far as mitigating damages, one of the biggest things is to protect yourself individually as a business owner.
Okay. So even following that piece up that you're saying, protecting yourself. So what have you found to be the most common mistakes that business owners make when it comes to taxes and their
I mean, it's a
investment
lot.
properties?
So one thing is that they'll have everything in their name and then they get sued. And then let's say that maybe the lawsuit didn't go well or whatnot. Now they have this lawsuit on their credit report. And credit is everything now. That's one issue. Another thing is they don't have the proper structure for their business. And one of the things I know what some investors do is that they form a business and then any properties that they may hold, they put it inside a trust. That way to protect them from additional liability. And that's like a whole nother conversation to discuss. But one of the biggest mistakes that I see investors do is that they do not seek legal counsel before they make business decisions. It's more than just having a business and making money, but you want to make sure that you're making the right decision for the best interest of your business. Not having someone to read your contracts, and as a result, you get contracts that you have no idea what they speak of, but you sign it and then you realize that this contract was not in the best interest of your business. Like I always tell people that it's one thing for you to read a contract, but if you're not an attorney, you're just reading words. You don't understand what they mean from a legal perspective. So that's one of the biggest things that I see investors do, which can hurt them, where they don't seek legal counsel to help them make great decisions for their business, or having someone read the legal documents like a contract or anything of that sort to help their business. They just try to do it on their own. But then they'll get advice after they got in trouble, after the contract was signed. And they're like, well, why am I not getting as much money for this deal? But they didn't read the contract. And then because of that, they signed something they had no clue what they were signing. And now they're in this big mess.
Gotcha. Okay. So two follow-up questions to that. And one, I know we can go off. That will be another episode to talk about. But I just wanted to bring clarity to something that you mentioned when you talked about putting properties into a trust, which is separate than a real estate
Yes.
investment trust.
Yes.
Correct? Like the stock market version.
Yes.
Okay. I just wanted to bring clarity to that. And you also mentioned, the mistake of not seeking legal counsel. So do you suggest that an investor have one particular attorney on retainer? Should it be something where it's retainer based, or is it something where it's more of a consultation based? What do you think is the best setup, or is it
I
personal
think it's
preference
preference.
or
So, well, let me explain
situational?
what a retainer is. A retainer is just an agreement that specifies that you're going to pay this attorney based on whatever need that you have. And a retainer agreement is just pretty much a contract between you and the attorney that specify how much you're going to pay and when the total payment is going to be due by. Now, you can have an agreement where it specifies that every month you're going to pay this attorney maybe $2,000 for maybe 3 hours of their time. So a retainer in itself is just an agreement. It's just what the words in the contract says, what each party is required to do on behalf of the attorney, on behalf of the client. But it's situational because some people may not make deals on an everyday basis. I know that for me, I used to work for the city of Baltimore in the Department of Finance. And so I know all the tax credits for the city of Baltimore. So if someone has a home that they owe, a home that they own, I can tell them what credits. But I worked a lot with investors. And what I did was when they were trying to seek different properties, I was able to tell them what credits they were able to get. But the good thing about these investors, they were really big companies. They always had an attorney on staff for them. And how they went about paying them, it could have been maybe like a monthly thing, but it's really up to the person. Like if you're someone that's not really active as an investor, you may need somebody on a, maybe a by case scenario. Maybe it's just one time you need them. It just really depends on how active you are with your business. Or you may have somebody quarterly. Or you may say, hey, I'm just going to call you when I need you. And then if there's a consultation fee required, then I'll just pay that.
Gotcha. And also, we're going to do another episode on those tax credits because you gave me a good idea with that. So I think that's something that
right. There's so,
I'm sure folks would want to hear
if
more
people
about.
are, for those that are residents of the city of Baltimore, there's so many tax credits out there. And I think based on my research, one, Baltimore is the largest city in the state of Maryland. Two, they offer the most tax credits in the state based on all the cities that's in the state of Maryland. And that's why a lot of investors come here to purchase, because they get so much benefit by buying here. But yes, we can definitely do another episode about the tax credits for the city. Yeah.
Yes, I'm excited. I am excited about that one. Okay. So an investor has purchased their first property. What should they then do leading up to tax time to make sure that their finances, their books, anything that relates to the finances with the property or the
So the first
acquisition of the
thing is, if
property
they're
are in
buying the
order?
property, is this the property that, are they still holding the property, or the property has already been sold? Those are the questions I always ask. Two.
Okay. Can we look at both scenarios, like a flip and
Sure.
hold and
So
then a flip and sold?
good. So in
So a
both
rental and
scenarios, it's
a,
very
okay.
important to keep track of everything that you spend. Every single thing that you spend. You should have some type of bookkeeper that understands real estate. By me preparing tax returns, and some of my clients get bookkeepers, after I look at the books, I'll tell them, you need to fire your bookkeeper. And the reason why I say that is because I take my job very serious, and I teach income tax. And one of the things I teach is, financial statements. And I can look at someone's books, and I'm like, this is messed up. And so the first thing is having a bookkeeper that really understands real estate and really understands what's considered an expense for that investor. That's one thing. For someone that has a property and it's on hold, they won't see the benefit of everything until it's being sold. So the expenses that they have, they can't expense out until it's actually sold, because they're holding the property. So there's no tax treatment. There's not going to be any benefit for them, nor would it be any disadvantage of them by not reporting anything. Because the expenses, what it's going to do is going to offset their selling costs. So whatever they expense out, they're not going to see the benefit of it until they actually sell it. Does that make sense? For someone that's actually selling the property, the things that they actually spent money on, they're going to see the benefit of it when they actually sell it. Now, the thing to keep in mind when you sell real estate, the person that's selling, and they're getting the person that's getting the proceeds from the sale, they will get what's called a 1099-S. And the 1099-S is going to show the proceeds from the sale, but they're not going to show the net profit. The net profit is the gross, the actual proceeds reduced by the expenses. So you need a really good bookkeeper that understands real estate to really keep track of all the real estate expenses. One of the biggest things with investors is that the people that did the work, your contractors. And so you want to make sure that when you are either flipping or you're having the property on hold, those contractors, they still got to get paid. So I'm pretty sure checks are being sent out. But there's an IRS rule that says that if you pay somebody over $600 for work performed for your business, you have to issue them a 1099. And so what I will recommend, whether you are still holding the property or it's already been sold, to also keep track of everybody that you paid as contractors and make sure that you submit their 1099s by January 31st of the following tax year, because failure to do so, you can be assessed with penalties for filing those things late. So those are some of the nuggets advice I would give someone that's holding the property or that already sold the property for a tax year.
Okay, I have millions of questions now. Okay, so we'll split it up and we'll talk about the flips and those that are then sold. So you mentioned the 1099 for the employees or for the contractors. Let me correct that, for the contractors. So 2 things with that. Is it one, ever too late? Let's say someone sold a property 3 years ago and they never did that. I mean, are they amending at this point? Is there a deadline for them to then make that correction?
So what's going to happen is
with
that
their taxes?
if they flip, they will have to, well, one, it depends that what usually happens is some people will expense out the money that they pay for contractors, but they never submitted 1099s to the IRS. So in that circumstance, let's say that 3 years ago, you already marked out how much you pay for contractors. And I'm pretty sure in the scenario that you gave me, the person already expensed out the money they pay for contractors, because believe it or not, that's a really big expense in the investment world. So they already probably paid them out. They just expensed them out. They just never sent a 1099. It's going to be to the disadvantage to the person that was a contractor, because now once those 1099s, those old 1099s, which is not a deadline to file, once those 1099s are filed and sent to the IRS will process them and say, hey, this person never reported this income. Now the IRS is going to reach out to those 1099s, the individual that received the 1099s, and tell they need to make changes to their individual tax return. So just think about it. If someone was a contractor for a work that was done in 2018, they already filed their tax return. They never received a 1099 for the work they've done for a investment group or investment company. And then 2020 is a new tax year and they just received a 1099. They may not feel the need to amend, but because the IRS has that on their books, they either have to amend as soon as possible, or what the IRS would do, they will make adjustments to their tax account and then send them a bill.
Gotcha. Okay. So this then brings up another question. 1099. Is this just for licensed contractors, unlicensed, individuals that are assisting? And, what if contractors are paying folks under the table? How does that work? How does that all factor in?
The general rule is that you pay somebody, if you pay somebody $600 or more, then you have to issue them a 1099. Now, people do not follow that rule, and as a result, they pay people underneath the table. You cannot track cash, right? You can't track cash, but as a taxpayer that's filing a tax return, if you look at the tax return 1040, you look at the bottom, it says under penalties and perjuries, you reported everything to the best of your ability. So if you are not reporting everything, if you're not issuing 1099s when you know you're supposed to, you're pretty much lying on your tax return. So it always go back to the question that not question, but the statement that I prompted earlier, is that when you have legal counsel in the beginning, you know all these things, so that way you're not making all these mistakes. So if you're paying somebody under the table, technically speaking, you should actually issue them a check to keep track of all the money that you sent. But however, there's a lot of people that are unlicensed, that's undocumented too, that are doing these jobs for investment groups, but the investment company don't want to issue them a 1099. They're just paying them underneath the table, and that is incorrect.
Got it. Okay. You also mentioned, keeping track of expenses. So I know with real estate, one of our biggest expenses is mileage. Is that something that's transferable to real estate investors? Is
Absolutely.
mileage an
You can
expense as
use
well?
a app called Mileage IQ. Everyone has their cell phone, and so what Mileage IQ does, it tracks all of your expenses. So you'll write in the address where you're going to, and then you will specify if it's business or personal. And then at the end of the year, they will actually give you a report, and it will tell you, the detailed report will have all the addresses that you went to for the year, and then the summary would tell you, out of all the addresses that you visited, what was actually classified as business and what was classified as personal. So yes, you can deduct mileage as an investor. Yes, you can.
And so investors should be using either their business address or their personal address as a starting point, correct
No.
or
So let's say
incorrect?
that pretty much you are able to deduct the mileage to the place that you're going to for business. So let's say that you're at Starbucks and you have a call to go to see this property. So from Starbucks, and if you're going straight to that property, whatever mileage that is, that's considered business miles. So there's no starting point from your business address. Wherever your starting point is at, and you're going directly to the place for business, those are the mileage. Your starting address doesn't have to be your business address or your personal address. It could be wherever you're starting at, going to that location.
Gotcha. But if you are home or you are in your business
Correct.
office, that then is your
Correct.
starting point.
Correct.
So whatever your
Correct.
starting point. Okay. So then while we're speaking about investors that are looking to flip houses, so rehab them and then sell them, can we also explain to the listeners about capital gains, what that is and
Yeah.
what that
So
means?
how capital gains work is that capital gains come into the picture when you're selling the asset, and a house is an asset, and whatever the profit is, you are subject to what's called a capital gains tax, and the capital gains tax can be up to like 35%. However, there's short-term gain and there's long-term gain. So let's say the holding period. So it's really important that when you have a property that you're about to sell, if you have a holding period, meaning that you held the property, meaning it hasn't been sold, if you held it under a year, you'll be subject to a higher capital gains tax. So capital gains tax, if you held it for over a year, may be maybe 15%. But if you held it for under a year, it may be 20%. And usually it's hard to figure out what's the capital gains tax until you actually do like a actual calculation to determine how much a capital gains tax they'll be subject to. So capital gain comes into effect when you actually have a profit on the asset that you sell, and it's pretty much a tax based on the proceeds that you receive from the sale. It could be 10%, it could be 15%, it could be 25% or 35%. And then it also depends on how long you held the property for. So some people can have a property for 2 years and never sold it. And so when they decide to sell it, because it's been held for over a year, it's called a long-term capital gain. That's a better treatment because it's going to be taxed at a lower percentage. So maybe taxed at maybe 20% or maybe 15% compared to if you held it less than a year, it may be taxed a little bit more. And it's hard to tell you what capital gains percentage you'll be taxed at until all the numbers are taken into consideration and there's an analysis done.
So when an investor sells a house, they're at settlement, they are signing the deed over to the new owner. capital gains is not calculated
So what
before then?
usually
That's something that
so
happens
what
later?
usually happens is that, let's say I have clients that are in the real estate business. They want to know how much tax they'll be subject to, like a capital gains tax. What I would do is I would do the analysis beforehand, so they already know what they're getting themselves into. But what I was explaining is that it's kind of hard for me to tell like the listeners, okay, you're going to be taxed at 10% or 15%, because a lot of things goes into play when trying to figure out how much capital gains tax. I had to look at the total big picture. I did this with one of my clients last year when they sold one of their properties, and I was able to look at, their other businesses, and then this actual sale, and how much capital gains tax they'll be treated, how much money they should put aside for taxes. That way, when they file their tax return, they're not surprised.
So just to confirm, so the result of the capital gains occurs at tax time, not
Right. So
at
capital gains
the time of sale.
capital gains is another tax. You don't see that until you file your tax return. Yeah.
Gotcha. Okay. All right. So then that leads me into 1031 exchanges, which, as a realtor, we've heard of this term. Some of us may have had experiences with it. I have had one or two. And when I first saw it, I'm like, what?
Mm-hmm.
I had to go look kind of 31 exchanges and other ways to potentially reduce tax
Yeah. So
burdens
I can
for
briefly talk
investors.
about that because it's a complex topic. A 1031 exchange just means that instead of you selling a property, you are pretty much doing an exchange to get another property instead. And so, for example, I had a client where they had a property in Upper Marlboro, and they did not want to sell it. They wanted to get another property instead. So when you think about a 1031 exchange, you're not, it's to the aspect where you're not selling the property, but you're getting another property in exchange. So there's different rules that you will have to go through to see, okay, can you actually do this? One of the biggest things with a 1031 exchange is that when you're exchanging your property, the other property must be of a higher value. So let's say the property that you have now is, I don't know, maybe $200,000. Then the property that you're trying to exchange, that value needs to be a little bit more than the property that you are exchanging. And so the 1031 exchange, it requires a lot of paperwork, and it also requires an attorney to go through everything, because I can tell you that the banks, some of them don't really understand the 1031 exchange. So that's just a brief synopsis. Usually it requires talking to the investor and like really going through detail. I know when I had a consultation, it was like a 2-hour consultation, just going over everything for the exchange. Mm-hmm.
Got it. Okay. So would you consider that to be just one way to try to, if possible,
It's a
alleviating tax burdens?
Yeah, it's
Kind of
another
making it
way to help with
easy
taxes.
transition?
I can say that. It's another way to help with taxes. It's another way to do tax
Okay.
planning if you're trying to reduce
Mhm.
taxes that you can pay.
Gotcha. And how complicated, we may not be able to get
It's
into it
very
on this episode,
it's very
but
it's
how
very complicated
complicated?
to the extent where
Oh,
it
well,
to even do the work, it can be costly. So it's a complicated type of exchange. Mm.
gotcha. Is that the same with the concepts of like recapturing depreciation and things like that? Because now we're going to switch over to, now the investor has rehabbed the property and wants to hold it. So talking
Depreciation
about
is
things like
also complicated.
depreciation,
So
how does that
So
work?
depreciation, what that means is that you're taking expense. So you're pretty much looking at the life of the asset, and you can't just, whatever the value of the asset, you can't just have it expense in year one. And so what depreciation means is saying that, hey, the value of this house may be $200,000, but over the next few years, we're going to take a portion of the cost, and each year is going to be an expense. So with the real estate, the actual houses is 5 years that you're able to take depreciation. So for those years, whatever the cost is, you just divide it by 27.5, and that's the amount that you're able to deduct every year. Now, recapture just means that when it's time for you to actually like sell the property, then one of the things that you have to keep in mind is that the depreciation that you took for over those years, you pretty much have to add that to whatever the cost that you're selling the house for. Because the IRS is saying from a practical standpoint, hey, we gave you the benefit of the doubt by deducting depreciation for all these years. But now that you're about to sell it, we're going to take this in consideration, and this is going to be included into the amount that you're trying to sell the property for. Now, I can tell you that recapture depreciation, that is a complex calculation. Like your tax software cannot do the recapture. Like you have to do that by hand. I did that by hand for a client. So those are things that you have to do by hand. But I think that when someone has a real estate company, then keeping track of everything makes the calculation easier, but it's still complicated. And some actual tax attorneys don't even know how to do the calculation. So you need to work with someone that actually knows how to do the recapture depreciation.
Okay. So then still looking at the hold side of things, how would you suggest, or what is the best way for investors to report rental income? How does that look when it's
rental
tax time?
income, you have to report the gross receipts the gross proceeds that you receive from the tenant. The misconception that I always see people do is that when they report the gross receipts, they don't report the total amount that they receive from the tenant. What they would do is they will report the difference between what the mortgage is and what the rent is. So let's say that the mortgage on the property is maybe $2,000, but the tenant is paying $2,500. They'll report the 500 as a gross amount. Well, 500 times 12 as a gross amount. And that's not how it's supposed to be. If you have rental property, you report the gross receipt that you receive for the year. So if someone's paying you $1,500 every month, you report 1,500 times 12. Now, some people don't do it like that, but that's what the law says. And that gets reported on the Schedule E. And then keeping track of all of your expenses. One thing that people don't know is that if you have a tenant in rental property and all you're collecting is rent, and that tenant is paying your utilities, the utilities that they're paying, technically speaking, that is something that the tenant, not the tenant, the landowner, that's considered additional income to them. So let's say like the average, I don't know, the utility bills is maybe $300 a month. Because the tenant is paying that on your behalf, that's additional income for you because you're not paying it. And so the law says that although you're charging on rent, but because the tenant is paying your utilities, because this actual property is in your name, whatever the actual amount of the utilities that's being paid on behalf of the tenant, and the tenant is paying that, the actual the landlord, they have to report that as income. So let me give you an example. Let's say if someone lives in a rental property, they're paying $1,500 a month. That's all they're paying. The landlord is not paying any other expense on behalf of this tenant. Let's say whatever the electricity bill is $100 per month, and the tenant is paying that. According to the IRS, the IRS is saying that electricity bill that the tenant is paying, but it's in the landlord's name, then they're responsible for reporting that amount as income because the landlord is not paying the utilities on behalf of the tenant in their home. Another thing to keep in mind too for people that have rental property, whether it's just a basic landlord or investors, is to keep track of all of your expenses, even traveling back and forth to your rental property to check up on it for upkeeps and things of that sort. those are mileages that you can actually deduct in your tax return. If you have to maybe kick someone out and you have to advertise, the advertisement is an expense that you're able to deduct on the tax return. Any, if you have like a property management company, that is an expense. So anything related to the rental can be deducted as an expense.
And that was actually my next question. So, what are either the most common expenses or the expenses that most people may not know or forget about or forget to include when they're making the list of expenses for their taxes?
Let's see. Well, let's say that someone is driving. Like, one of the biggest common mistakes, honestly, is one of the expenses I just mentioned is mileage. A lot of investors or anyone that does real estate that have rental property, one of the biggest things I see them overlook is mileage. That's a big thing, and keeping track of the mileage. Another thing too is depreciation. That's an expense that you're able to report, but your tax software should be able to calculate how much depreciation you're able to deduct every year. If you have people that you're paying to help you with the upkeep of your property, you can actually pay them. So, and that can actually be an expense. So those are some of the common ones that I actually see. But I think one of the biggest things too is just to be organized. Have your rental income in a separate account than your personal account. That's another mistake that I see, because that's considered a business, and the IRS says that you cannot commingle funds. So keep everything in a separate account for your rental property. Whatever the tenant pays, have it go in that one account. Whatever you're paying out for the rental property, make sure it's going out of that particular account.
Got it. I'm telling you, you are flowing right into my next question. This is beautiful. Just following up with what you said before. So you recommended having a bookkeeper, help with the tracking of expenses and income. And then you mentioned like the Mileage IQ app for mileage. But if an investor is looking to kind of keep their own book so that they can compare with their CPA or bookkeeper or tax attorney, is there software or is there something that you suggest that an investor
So
do to
here's the
keep
thing.
track
So
to
when I
manage
say
these
hire a
expenses?
bookkeeper or someone to keep track, so what happens is that whenever you hire a bookkeeper, um, they will always recommend that you have a software to pretty much the software will be linked to your business account. I like QuickBooks. They have one called Wave. It's free, but it's a public domain through Google, so anybody can like try to hack in and go through your Wave account. And there's some other ones, but I like QuickBooks. That's what I use for my business. And so what QuickBooks allows the user to do is that it allows the user to have access to their account so they can see all their expenses. And then you can add a admin, a CPA to the account, or an accountant, whoever's doing the book, so that way they can have access to see exactly what you see. What the bookkeeper does is that because the actual QuickBooks is linked to the business account, they're able to see all the transactions for the year. And what the bookkeeper does, they're able to look at each expense and make the right categorization. They can categorize this expense, whether it's food, entertainment. What I don't recommend is someone to have QuickBooks and someone to try to do their bookkeeping on their own and then give it to a bookkeeper and say, hey, let me know what you think. Why? Because if you're a non-attorney or you're a non-tax professional, you don't know what's classified as an expense. Like, one of the biggest things is that with the new tax reform, entertainment expenses is not deductible. So you may take your client out to a jazz festival, and that could be a good way for you to claim clients. But if you don't know that the new tax reform doesn't allow entertainment, that's an expense that's not going to be accounted for when it comes to tax time. So that's how the actual bookkeeping process works. Some people do it by hand. I don't know why, but I like QuickBooks. I swear by QuickBooks. I had QuickBooks for the last 3 years, and it never failed me. So I like it. And then on top of that, by using QuickBooks, it is an expense to your business. So it is an expense that you could actually write off. So although you're paying for the service, it's actually helping your business. And then another thing is whatever you paid is going to be subtracted from the total income that you receive from your business.
Got it. Okay. And then my final question, and you actually have led me into this one as well. So you said that, you wouldn't suggest that individuals that are not well versed in taxes or that are tax professionals to know the law. Like that's why they should
Correct.
seek guidance from the professionals. Have there been any recent tax changes and or upcoming tax changes that would directly be advantageous or be to the disadvantage of those looking to get into real
Um,
estate investing?
no, it hasn't been something that would be not in the best interest, but they have what's called the qualifying business expense that investors can be eligible for, and it's a 20% deduction from their net income that they've received for their income for the year for their business. So that's something that the new tax reform implemented, and it became in effect for tax year 2018. So if you filed your tax return for 2018, that's something that you could take advantage of, as well as for tax year to 2019. So that's something that has helped clients. Another thing is when it comes to real estate investors, let's say some of them had LLCs and they never considered a corporation. Now with the corporation tax rate, it went from 35% to 21%. And so this is a good time where you look at your profit and loss statements for the last 3 years and figure out if a corporation may be advantageous to you, but you would need an attorney to really dive into your tax returns, your profit and loss statements, even looking at some of your pretty much your financial statements to see if it's in the best interest to now be a corporation compared to an LLC. So right now, there's nothing um, that will be at a disadvantage. I know that right now it's not final, but it's in legislation that there was a new article that I read 2 days ago that Maryland, the state of Maryland, is trying to implement sales tax on professional businesses. And so as a result, a real estate investor, even an attorney, can be assessed with paying sales tax. So it has not been final yet, but that's just something up in the air that I've been reading about. So that's the only thing I can think of that can be, not so beneficial to business owners. But other than that, it's one, the qualifying business deduction, as well as the whether you should change your LLC to a corporation. And then the not so good news is the sales tax for professional businesses for the state of Maryland. But that's all I can think of right now. Yeah.
Mhm. That's good enough. That's more than enough. Well, folks, there you have it. Sakinah Tillman of Tillman Tax Law Firm, LLC. Sakinah, if the listeners are interested in getting in contact with you, they have questions, they want to set up consultations or appointments, get their taxes prepared, need to go to
Yes,
court,
they can
how
actually
do they
go
reach you?
to my website. It's tillmantaxlawfirm.com. You can actually submit a information request. I get that immediately through my email. You're able to submit your questions and we can move forward there. Or you can also email me at Sakinah, that's SAKINAH, at Tillman, TILLMAN hyphen LLC.com. Or you can follow me on social media. For Instagram, it's Tillman LLC. Every Tuesday, I do what's called Tillman Tax Tips. I provide free tax tips to my listeners about ways to save from a tax perspective and just give them, advice about someone that's a W 2 employee compared to someone that is a business owner.
Got it. Well, thank you so much again. And thank you all for joining us for another edition of Real Talk and Real Estate with Kim McBride, also known as your girl, Get
Thank
Keys
you.
with Kim. Have a great day.